Have you ever wondered about the secret dynamics between gold and silver prices? Imagine a world where you're not just buying and selling, but trading the relationship between these two precious metals. We're talking about the gold-silver ratio, a fascinating and potentially profitable aspect of trading. This ratio has its mysteries and allure, but it also holds the promise of significant returns for those who know how to navigate its ebbs and flows. Stay tuned if you're curious about how to trade the gold-silver ratio. To begin, we must first understand what the gold-silver ratio is. Simply put, this ratio represents how many ounces of silver it takes to purchase 1 ounce of gold. It's a measure that has been used for centuries, dating back to the ancient Egyptians and beyond. Historically, this ratio has fluctuated greatly. For instance, during the Roman Empire, the gold-silver ratio was set at 12:1. Fast forward to the 19th century in America, and the ratio was legally established at a 15:1 ratio under the Coinage Act of 1792. Interestingly, in the modern era, the ratio has seen even more dramatic shifts, with peaks reaching as high as 100:1. The gold-silver ratio is more than just a historical curiosity, though. It's a crucial tool for traders and investors in today's market. You see, this ratio helps identify potential opportunities for arbitrage. When the ratio is high, it suggests that silver is undervalued relative to gold. Conversely, when the ratio is low, it indicates that gold may be undervalued compared to silver. Understanding the gold-silver ratio can also provide insight into the broader economic landscape. Typically, a high ratio can signal economic uncertainty or turmoil, as investors flock to gold, deemed a safer asset. On the other hand, a low ratio often corresponds with periods of economic stability and growth, where silver, often used in various industries, becomes more desirable. Moreover, the gold-silver ratio can be used as a diversification strategy. By trading this ratio, investors can potentially hedge against market volatility and protect their portfolios. It's a dynamic strategy that allows for flexibility and adaptability, key attributes for any successful trader. So, there you have it. The gold-silver ratio, a historical measure that continues to hold relevance in today's ever-changing market. It's an indicator that can provide valuable insights, identify potential trading opportunities, and help manage risk. Now that we grasp the concept, we can delve into the exciting world of trading the gold-silver ratio. Trading the gold-silver ratio may sound complex, but with a few key steps, it becomes a clear strategy. You might be thinking, how does one even begin to trade this ratio? Well, let's break it down. First, it's crucial to understand that the gold-silver ratio is simply the amount of silver it takes to purchase 1 ounce of gold. This ratio fluctuates as the prices of gold and silver change, creating opportunities for savvy traders. Now, the first step in trading the gold-silver ratio is to monitor the prices of gold and silver regularly. It's like keeping your finger on the pulse of the market. You need to stay in tune with the ebb and flow of these prices to spot potential trading opportunities. But here's the catch, you shouldn't just follow the prices. It's equally important to understand why these prices are changing. Is it due to supply and demand dynamics? Or perhaps geopolitical tensions are influencing the market? Maybe it's economic indicators such as inflation or unemployment rates. Whatever the reason, understanding these factors gives you a clearer picture of the market and helps you make more informed trading decisions. Remember, in this type of trading, you're not directly buying or selling gold or silver. Instead, you're speculating on the ratio between the two. So if you expect the ratio to increase, meaning gold will become more expensive compared to silver, you might decide to buy gold and sell silver. On the other hand, if you anticipate the ratio to decrease, you might choose to do the opposite. In essence, trading the gold-silver ratio is like a dance. You need to be aware of your surroundings, understand the rhythm, and make your moves at the right time. It's not just about the numbers, it's about understanding the story behind those numbers. So, keep an eye on those gold and silver prices, understand why they are moving the way they are, and dance to the rhythm of the market. Understanding the prices of gold and silver is the first step in trading the gold-silver ratio. Now let's delve into the steps of trading the gold-silver ratio. First and foremost, you need to understand what this ratio means. It's a simple calculation of the price of a single ounce of gold divided by the price of a single ounce of silver. This ratio tells you how many ounces of silver it takes to purchase 1 ounce of gold at any given time. Now, onto the actual trading. The process commences with thorough research and analysis. You have to study historical data and observe the fluctuating trends of the gold-silver ratio. Typically, when the ratio is high, it means gold is overpriced compared to silver, and when it's low, silver is overpriced. You'll want to buy when the ratio is high and sell when it's low. However, it's not as simple as it sounds. Timing is everything in trading, and it applies to the gold-silver ratio as well. You need to be patient and wait for the right moment to strike. It's all about buying and selling at the right time to maximize your profits and minimize your losses. Next, you need to keep a keen eye on market trends. The price of gold and silver are influenced by various factors, including economic conditions, political events, and market demand. You need to stay updated with these factors and understand how they impact the gold-silver ratio. In addition, make use of indicators to assist your trading decisions. Indicators such as moving averages, relative strength index, RSI, and Bollinger Bands can provide valuable insights into the market trends. They can help in identifying potential buy and sell points, allowing you to make informed decisions. Now, let's talk about the actual trading. You can trade the gold-silver ratio through various instruments such as futures, options, or exchange-traded funds, ETFs. Each of these has its own advantages and risks, so choose the one that suits your risk tolerance and investment goals. Remember, trading the gold-silver ratio is not about making quick profits. It's a long-term strategy that requires patience, discipline, and a keen understanding of the market. You need to be prepared for market fluctuations and have a sound risk management strategy in place. Lastly, always review and assess your trading performance. This will help you identify any mistakes or areas of improvement. It's also a good practice to keep a trading journal to document your trades, observations, and insights. This can be a valuable resource for refining your trading strategy and improving your trading skills. With these steps, trading the gold-silver ratio becomes a feasible strategy. While the process may seem straightforward, there are common pitfalls to be mindful of. Firstly, a common mistake is not understanding the gold-silver ratio itself. This is a measure of how much silver it takes to purchase 1 ounce of gold. Misunderstanding this concept can lead to costly mistakes, so ensure you comprehend it fully before diving into trading. Secondly, many traders fall into the trap of not using stop losses. A stop loss is a predetermined amount of risk that a trader is willing to accept with each trade. It's a safety net, preventing you from losing more than you can afford. Not using stop losses can lead to substantial losses, so make sure you're implementing them in your trades. Next, let's talk about overtrading. Overtrading occurs when you make excessive trades, often driven by emotions rather than strategic planning. This can lead to unnecessary losses, as not every moment is a good time to trade. To avoid this, establish a trading plan and stick to it. It's crucial to remain patient, waiting for the right conditions before making a move. Another common mistake is not considering the wider economic context. The gold-silver ratio is influenced by a variety of factors such as inflation, interest rates, and geopolitical events. Ignoring these can result in a lack of foresight and poor trading decisions. So always keep an eye on the broader economic landscape. Lastly, remember that past performance is not indicative of future results. Just because the gold-silver ratio has acted a certain way in the past, doesn't mean it will do the same in the future. Therefore, don't base your trading decisions solely on historical data. Instead, use it as a tool to understand potential trends and risks. By avoiding these common mistakes, you enhance your chances of successful trading. Remember, trading the gold-silver ratio is not a guaranteed way to make money. However, by being mindful of these pitfalls, you can increase your potential for success. Let's recap the key points about trading the gold-silver ratio. We've walked a long journey today, exploring the depths of this intriguing trading strategy. Firstly, we delved into understanding what the gold-silver ratio is. It's a simple calculation that shows how many ounces of silver it takes to buy 1 ounce of gold at a specific point in time. This ratio has fluctuated throughout history, and tracking these changes is key to leveraging it in your trading strategy. Next, we discussed the intricacies of trading the gold-silver ratio. It's not just about buying and selling gold and silver, but rather understanding the market dynamics that influence these precious metals. We learned that the ratio tends to rise during periods of economic uncertainty and fall during periods of economic growth. This is because investors often turn to gold as a safe haven during turbulent times, pushing up the price of gold relative to silver. We then moved on to the practical steps to trade the ratio. We learned that the first step is to analyze the historical trends of the ratio, followed by deciding whether to trade physically or through derivatives. Then we discussed the importance of setting up a trading account with a reputable broker, and finally executing the trade at the right time. And of course, we couldn't forget about the common mistakes to avoid when trading the gold-silver ratio. These included not conducting thorough research, failing to diversify your portfolio, not setting stop losses, and letting emotions control your trading decisions. So there you have it, the gold-silver ratio in a nutshell. It's a unique trading strategy that requires a good understanding of market dynamics, careful planning, and disciplined execution. It's not for everyone, but for those who master it, the rewards can be significant. With these key points in mind, you're well on your way to trading the gold-silver ratio. Trading the gold-silver ratio may seem daunting, but with the right strategy, it becomes an exciting opportunity. This is a game of patience and precision, a dance of numbers that can lead to substantial profitability if played correctly. A balanced mix of knowledge, strategy, and intuition is key. Let's not forget, the gold-silver ratio is not just another trading tool. It's a reflection of two of the most precious metals known to man, two commodities that have stood the test of time. When you trade the ratio, you're not just participating in a market, you're becoming a part of history, a part of a legacy that stretches back thousands of years. The potential profitability of trading the gold-silver ratio is immense, but beyond the profits, there's the thrill of the game, the satisfaction of making a well-planned move, the joy of seeing your strategy unfold in real time. It's a journey of discovery, of learning, of growth. So don't just stand on the sidelines, step into the arena, take that first step, start trading, embrace the challenge. Because in this game, the only real loss is not playing at all. Remember, every master was once a beginner, every pro trader started with that first trade, so why not you? Why not now? With the knowledge from this video, you're ready to dive into the world of trading the gold-silver ratio. Happy trading!